Sure, there are some Fed fears with that because of the pace of the rise in rates, but it's a good economy, so therefore we are going to have higher rates, and investors are just going to have to get used to that. I think investors are just, right now they're just trying to digest how this is going to affect earnings, because at the end of the day, it's always earnings that drive the markets. And so we're right in between earnings season. We're starting earnings season for quarter 3, and we're going to take the investors want to see what the companies are going to be saying about how these higher rates are going to impact their earnings. So that's why we see this part of the market where we're seeing a lot of unsettled, a lot of investor panic, selling out. But it's really, once we start to see earnings, I think that investors will settle down a bit.
You want to weigh in on that, Mike? Because what they're already seeing, they don't really like, right? PPG, Fluor, Fastenal. You've already gotten commentary from some really important industrial companies, and it hasn't been good.
Yeah, look. The first thing to import is that this feels very different than the sell-off in February did. This is not a panic. This is more of a rotation. And the reason you see that, if you look at the dispersion between the best and worst sectors back in February, it was really narrow between things like technology, even defensive sectors like utilities. You look at it now, and it's much wider. So that makes it seem like investors are starting to reevaluate a lot of the things that have already been in the news. So investors are becoming a little bit overconfident in terms of the economic fundamentals that have been occurring, plus with earnings. And that's led them to take probably bigger risks than they should have. You know, if you look at IPOs this year, we've seen 83% of them come out with negative EPS. It's the highest rate of negative IPOs since the late 1990s. The idea there is people are starting to reevaluate that growth trade and really starting to look elsewhere.
You know, Scott, one of the things that we don't have this time around that we did back then as well is all of the volatility-related shenanigans, all of these short ETFs, long ETFs, ultra-levered ones that really caused a lot of panic selling. So maybe that's the reason why you're seeing these isolated, more fundamentally valuation-driven arguments about maybe just technology and consumer services as well, Scott.
Yeah, Karyn, I mean, why don't you weigh in on that, right? I mean, this is more fundamentally driven than that, you know, the VIX product blow up that we had at the beginning of the year. You could make the argument that thus this is more concerning because it's happening for all of the reasons that investors wouldn't want it to.
Right, but I would counter that. I think that investors are not confident enough. I think that they think that the tax cuts are a one and done or a sugar high, and they're not really seeing the fundamental growth in the economy. So I think they're going to be pleasantly surprised when they hear what's going on in earnings. Sure, we have had some companies say that they're going to be impacted by rising rates and by the tariffs and what's going on with China. But I think that overall, companies are still making a lot of money, and that even though the rise in the earnings growth rate may slow down somewhat, we're still seeing some very healthy earnings. So I would say that investors are not confident enough, but when we see earnings season play out, I bet you they will have that confidence, and they'll realize that the economy is good and earnings are good. So this sell-off here is just a normal correction, and higher rates is higher growth, and that's just par for the course.